Mark is a principal investment advisor at EVP. They're a venture capital firm based in Sydney, and they specialise in investing in B2B SaaS companies. So Mark has a wealth of experience in the industry. We're really excited to have you on today, just keen to delve into some of your insights around B2B SaaS companies. And I think today I'm really keen to understand how B2B SaaS companies can survive and thrive in turbulent times. It's been a bit of a rocky road the past couple of years, a lot of interesting learnings, I'm sure, but also a lot of massive wins. So yeah, thanks for joining us today, Mark, and looking forward to talking to you more.
Thanks, Ryan. Pleasure to be here.
I think for the first question, let's just keep it easy, as I typically like to do. Can you just start by giving us a brief overview of EVP and your background?
Yeah, sure thing. So EVP, we're a venture fund and we invest across Australia and New Zealand. As you pointed out, our primary point of difference is that we're specialist B2B software investors, and it's a market of several generalist funds across Australia and New Zealand. And we've just found that to be really, really helpful in getting to know businesses and helping them out after the fact. It's just that specialized focus. We invest from the Series A stage and deploy a highly active approach to a concentrated portfolio, typically leading rounds and taking board seats with all our investments. I suppose we've been doing this for about 10 years as a funds management business, and now have 45 portfolio companies across about $300 million worth of funds we're managing. And I think the most exciting thing for us is we're starting to see some of those portfolio companies emerging as iconic success stories in that B2B SaaS space, locally, with the likes of Deputy, Ignition, Shipit, Mutinex, Autograb really hitting their strides. Over on your side of the ditch in New Zealand, we've had the benefit of working with 4 businesses so far: Henry, Fergus, Movin, and Inside AI, some of our best performing businesses, frankly. We're actively investing out of our 4th fund at present, and we're on the lookout for great founders doing interesting things in that B2B software space. So I've been with EVP for about 5 years and on the investment team, and been fortunate to lead some of our investments into the likes of Autograb, Programmer, Servicely, Teleschool, ClearCalcs, Coreplan, and Car Clarity.
Yeah, cool. That's a lot of companies to work across, no doubt. And I love that, you've obviously, I'm a little bit biased, but I think it's great to have a really clear focus on one specific type of business. Do you think you've been able to sort of really build up a level of IP and understanding of SaaS businesses that other VCs that go a bit broader might not have?
It's a good question. I think there's certainly benefit, learning. I don't know if it's that you necessarily have, we're smarter people or anything like that. There is just benefit from focus. When all you do is think about, dream about is a certain business model and how SaaS businesses works, it's, I suppose we just find it a lot easier in learning about businesses and doing that helping thing on the other end. Just little things, tips and tricks of how to scale a software business, how to do international expansion, how to think about pricing and packaging. All these elements really do, are quite specific for the B2B SaaS, business model. And there's just certainly accrued learnings we've had over the journey, basically stealing great ideas from, the businesses that were early on in the journey, and looking to apply them. We just do find that really, really valuable.
Yeah, no, I can imagine. And I think, what I love about B2B SaaS is that they're great export businesses. Obviously, New Zealand, Australia, both on sort of the far side of the world compared to most countries. And I think, with SaaS, it's amazing how you can just sell into America literally can be global from day one. It's a lightweight thing to export. Obviously, it doesn't need to be physically moved anywhere. That's great for the environment, and there's just all sorts of benefits, I think. But one of the focuses I was keen to chat about today is really just B2B SaaS resilience. Obviously, since COVID, there was a black swan event, and it imbalanced a lot of sectors and businesses around the world. As you know, obviously there was a big run up in the VC market, and that was arguably a good thing in terms of access to capital and those types of things for B2B SaaS companies. That obviously on the swing side has also had some harder lessons to be learned. COVID was a black swan event, no doubt. It's something that supposedly only happens every 100 years. I know companies like Zoom had big payoffs, others had to dig pretty deep and pivot. How did the EVP portfolio fare during that time?
Yeah, good question. I think it's quite nice, to be honest, to be able to sit a few years, post that COVID disruption and really look back and see how it works when you're in the thick of it. and doing, weekly board meetings and the like and trying to figure out how to thrive or how to, survive. It's, very different to be able to actually look back in retrospect. Looking at it, I think it was about a third split across the portfolio. There were those that, had massive tailwinds, acceleration of demand and all the rest of it, and saw amazing growth. There were those that kind of continued on their existing trajectories and kind of just, those business as usual. And then there were those that were sadly in the crosswinds of, challenging industries with massive headwinds, servicing those businesses that, largely shut off over a period of time. Maybe just to talk to, two ends of that spectrum, on the positive side, there was, the likes of Shipit that sells logistics software to e-commerce merchants, or, Autograb selling pricing intelligence solutions to the automotive industry, CoView selling, telehealth solutions for doctor's appointments to do at home. These businesses just saw, customers running through the doors, trying to get into the software, trying to adopt a new way of working. And it was very much a story of, how do we meet that demand? How do we scale up quickly? How do we, hang on to the rocket ship? And then on the other side, you had folks that were really, really challenged and, selling into, the travel space in the case of, SiteMinder or Resdy, or hospitality industry, Deputy, eClub, and a couple others. For them, it was really, really hard. Frankly, if you look at hospitality, I think, it's looking at industry statistics, it's a little hard to pin it down, but something like 10 to 20% of the industry literally closed down businesses. Restaurants, cafes just don't exist anymore. And, managing through that environment is really, really tricky as to, what you do with your business. In hindsight, it's pretty amazing to see that those businesses all did survive really nicely, which, clearly end up thriving now. Clearly, part of that is management teams doing pretty heroic work during COVID and subsequent, but clearly it also speaks to the business model, which I know you love equally as much as we do, in terms of, mission critical software solutions where it's literally the last thing you pull out before you turn off the lights, high margin businesses where, you can go profitable pretty quickly, low cost of distribution and all the rest of it. Sticky customer bases, all these elements really, we talk about them in theory, and there's a reason investors love B2B software, but to actually see that theory play out in practice was pretty cool to see.
Yeah, it is interesting just how much some sectors got hugely affected and others just got, these massive tailwinds off the back of COVID. And, it's really like a case of right place, right time, right? Resdy or SiteMinder didn't do anything differently to have to, deal with those issues. But obviously the way that they dealt with them has definitely set them apart as well. Obviously with that exposure to the travel industry and hospitality sectors, what are some of the strategies or actions that these companies in your portfolio took to survive and thrive during that period? Or,
Yeah, good question. I think, I was thinking about this. There's probably four things that really stood out. I think, the first one is just really understanding where your customers are at in their life cycle and meeting them there. If you think about Resdy, they sell software to tour and activity operators. So think about your walking tours, your kayak trips, your harbour boat cruises, whatever it may be. It's software to manage those businesses. Those customers were literally just gone. Like Resdy sells, so it's part subscription-based, part kind of volume-based, transaction-based revenues. The transaction revenue within a 2-month period literally dropped to 1% of what it was or something silly like that. And I think that business was faced with a big question. Do you churn out these customers that can't afford to pay you for the software? What do you really do in that situation? And I think to, the CEO and CFO at the time, Chris and Kevin, who were running the business back then, they did pretty heroic work to really get close to the customers and understand, what are you going through? What's the appropriate thing? How should we kind of treat those customers in that tricky situation? And, to their credit, they said, hey, we're going to put a bunch of you on hibernation plans. We know you cannot pay us now. Let's figure out a plan to work through that together. We would otherwise probably be thinking of price increases at that point in time if there wasn't this COVID disruption. Let's put that on hold for a couple of years. Let's just really understand what our customers are going through and meet them where they are. So I think that was a pretty important one, just to kind of, both as a economically rational thing to do to make sure you've got those customers at the end of the day, but also just to carry some goodwill in what was truly unprecedented times. The second thing I think folks in the portfolio did really nicely was just narrowing the focus to where you have sharpest product market fit. So I think in reality, there was a new market environment and things changed. And, suddenly where you think, I can sell really nicely into restaurants who have huge ability to pay and, they want to use our software and there's big value for them, suddenly that equation changed. I think the other thing that probably changed as well was, businesses' tolerance to accept maybe not quite ideal customers. As you grow, you naturally just pick up a whole bunch of customers that maybe don't fit the ideal customer profile or come from another industry who can still make use of the software. And you might start spending some money to acquire those customers. Clearly, in challenging times, you just got to narrow the focus and really understand which are our really profitable customers that can afford to pay for the product. They're not going to churn out after a couple of months, and you can kind of keep tackling them. And I think, the Deputy and eClub folks did really nicely on that front. So eClub that sells its kind of dynamic pricing software for restaurants to be able to fill tables when, they might not otherwise be as busy. In their environment, they said, hey, we previously had a pretty broad approach. Let's really narrow in on specific postcodes where we know there's high demand for restaurants, the customers are profitable, and it's, a really good use. So going from almost a national approach to a postcode-based approach. If we think about Deputy, they sell, shift management software for small businesses to manage the casual workforce. For them, it was to say, hey, restaurants, again, they don't have huge ability to pay for software right now. They literally closed down, not really allowed to operate as they were. Medical clinics was something they'd done in the past who suddenly had an influx of demand, massively growing workforces that needed to cope in that scenario. And they kind of acknowledged that and said, hey, that's where, right now, that's where product market fit is. Let's go after that. So I think narrowing that focus is important. A third one that was, pretty interesting to see was just recalibrating the rhythm of the business for the scenario you're operating in. So if you think about, most of our companies might do quarterly or monthly board meetings because you say, hey, I've got a quarterly sales cycle and I'm an enterprise software business. There's no point in meeting more often than that. And that's the rhythm I operate my sales team. That's the rhythm we're working with. In that situation where things were going pretty crazy, for Resdi as example, it was kind of a week by week proposition as to which parts of the markets were shut down. How do we respond? What do we do with pricing, et cetera, et cetera. That turned into a weekly rhythm with board sessions to discuss these things, recalibrate on what's going on in the market, and really understand that stuff. So that was, I think, really, really important just to be able to respond nimbly and, have the attention appropriately. And then I think the final one is just getting really deliberate on cash burn. So I think, historically when, maybe cash is abundant or when your business is flying, maybe there was an approach that said, hey, I've got $5 million in funding. I want to use that over 2 years and I'm going to, whatever it is, spend 200 grand a month. That's going to get me there. And, they'll burn 200 grand a month and that's how we're going to, treat our cash balance. I think when things are a little bit scarier, what the best founders in the portfolio did was to say, hey, let's get really deliberate about our risk parameters of how we want to operate here. What's the minimum cash balance we want to have? And some rules of thumbs that people use, typically it's like 3 months OPEX, or it might be 6 months runway, whatever it is. Let's get really clear as a board what those minimum parameters are. And then let's get also really deliberate what the cash depletion cycle looks like into that point. So we don't want to be running out of cash when we're still burning. How do we figure out what a soft landing might look like? How do we make sure we use the cash we've got probably earlier in the funding cycle? If we hire a salesperson, we want to give them time to actually provide value rather than hiring a salesperson when you've got 3 months runway and you don't even have time for them to ramp up. Just little things like that, getting really deliberate on the cash burn, I think paid dividends for a bunch of the portfolio companies. So yeah, I think those 4 things around just listening to customers, meeting them where they are, narrowing the focus, product market fit, figuring out the appropriate operating rhythm, and then getting deliberate on cash burn were probably the things that stand out as to, how folks managed to survive what was a truly crazy time for some of them.
Yeah, for sure. And I think it's interesting because when the market goes up or things change quite a lot, often it's those that really just hone in and focus that are able to sharpen the tools in those areas and do really well, like no matter what the circumstance. And like some of the patterns that I've definitely noticed from talking to businesses that were working through COVID, SaaS businesses, or working with them ourselves via Atlas, was certainly just around like really just listening to your customers, understanding their problems, and then narrowing in and honing in on those ICPs that work the best as well. So in some ways, I think, during COVID, certainly I doubt anyone felt like this, but it's the type of thing you like look back and probably it was like, some of those changes that we were forced to make are probably good and have helped those businesses really thrive today. I think on that note, are a lot of those businesses that pivoted still taking that direction, or have new opportunities opened up for them now? Things are a little bit more settled with, no more lockdowns and whatnot.
Yeah, it's a good question. I think by and large, they probably settled back into their original rhythms, but as you say, probably with a much healthier business. Deputy is probably the one that they've kind of gone back to their heritage of just selling small businesses generally with a horizontal solution. But, eClub's continued with this really sharp focus on which postcodes do we want to tackle, get to high density, get nice margins going and really go after that one. ResD's kind of, all of these businesses, weirdly, if you look at their growth charts, it's hard to see COVID for a lot of them. Maybe an eClub might be different, but if you look at Deputy, for example, we were looking at the kind of annual revenue numbers, you can't actually see a dip. It kind of just, it kept growing, and they managed to, I guess, steady what would have, could have been scary churn, but continue growing through the period. So, I think by and large, the portfolio has emerged with, much more discipline on capital management, much healthier kind of financial profile around, just capital consumption versus the growth rate that they're achieving, and just probably a sharpened approach for how they go about growth and which customers they tackle.
Yeah, that's really interesting. And I suppose on the flip side, and certainly don't need to name any companies, but just from seeing the companies that didn't fare well, perhaps they're not in the EVP portfolio, you're just aware of them. What were some of the patterns you noticed where the companies just, either they had like a big tick up during COVID, like say Zoom, and then they've dropped off, or a company like Zoom that, ticked up and then dropped off quite a lot, or maybe companies that just encountered challenges but didn't adjust to them? What are some of those patterns that you picked up there that seem to occur?
It's a good question. I think and thankfully the EVP portfolio is in really healthy spot. Even the businesses I mentioned, all of them, frankly, are thriving now. Like it's pretty remarkable to look back on it, which again probably speaks to a really beautiful business model in B2B SaaS with mission critical software. I think as I reflect on ones that maybe didn't adjust, appropriately during the times or have struggled since, it's really about the agility of the team to respond to that current environment. So, if I think about a business that, responded really nicely, like one in our portfolio is, Zipline. They were previously selling sentiment analysis for retail stores, where you go into a 7-Eleven and you say whether you're happy or you're not happy. And they're still selling that, but they identified really quickly that suddenly check-in software and visitor management software for hospitals was really important. They did a rapid pivot and they kind of exploded through COVID. It was great. There are others who kind of have stuck to, not necessarily in our portfolio, but you see some founders who kind of didn't see the opportunity, or either didn't respond during COVID or subsequent to a new operating environment. So, there's some in, I won't name names or even industries because they're small players, but we're seeing a few now where, massive acceleration of demand, which has probably dipped a little bit as you're getting back to the long-term trend on growth. You see a few that are still operating as if things are accelerating, 40% year on year as an industry and crazy tailwinds. But the reality is less than that, and the growth characteristics of the company don't necessarily support, massively high burn rates. So I think that ability to really recalibrate and say, hey, what's the current operating environment? What's my risk tolerance? Where are we playing? And therefore, how do I think about the capital I've got to play with? I think always doing that in a really agile way, and keeping in sync with those risk parameters is really important. And the ones that I think that have struggled have failed to adopt to that quickly enough, I would say.
Yeah, interesting. And certainly you've touched on a few points around, product, the verticals or sectors that people are operating in, and the leadership teams as well. How has an event like, or how have unforeseen changes like COVID changed the way that EVP might analyze companies for future investment? Like how, what's something that you might have learned that you probably didn't put as much weight into in the past that these days you might think, actually, how resilient would this business be during a downturn?
Yeah, great question. I think, clearly the market is now rewarding quality of revenue as much as, not quite as much as overall growth rates, but it's just a big valuation factor. I think that's probably something that we are perhaps thinking a little bit more carefully about in terms of, B2B software is pretty broad. You've got some solutions that are absolutely mission critical and you rip it out and you can't take bookings or you can't get paid, you can't pay your staff, like proper mission critical stuff that the entire business is operated on one end of the spectrum. You've then got some solutions that might be, intelligence or reporting, or it might be, tools and widgets that are helpful but not necessarily mission critical. I think on the way in, just having a really strong appreciation of, what is the value that the software is providing and how resilient could that potentially be in a disrupted environment. I think that's probably something we just ask ourselves a little bit more. Clearly, software that helps me generate revenue or software that, keeps the lights on and enables me to run my business is, clearly more exciting on our end. But I suppose it's just a question on the way into an investment.
Yeah. And what about, payment revenue, transaction revenue is certainly something that seems to have grown, at least from my perspective, in the past few years. How do you look at valuing companies that have, say, like a large percent of their revenues actually from payments and transactions and cash flows coming through their business as opposed to just the subscription value?
That's a great question. And it's, that whole, all SaaS is a fintech was a bit of a phrase that was floating around a couple of years ago. Certainly we've seen huge success in the portfolio with embedded finance within software products and just payments revenue, frankly. And frankly, we're big fans. I think there's probably a few things that we think about. One is we value it on a net margin basis, i.e. there's no point in saying, we only keep 30% of the payment fees we get and we have to pay out the other 70% to Stripe or interchange fees and all the rest of it. We just don't think it's reasonable to value it at the top level. You value the clip that you kind of keep after the fact. So from a margin perspective, it still kind of looks like a SaaS, subscription revenue line when you value it appropriately. I think the other one as well is just getting a real understanding as to how recurring that payments revenue is. For most of our businesses that have done this, it's as reliable and as predictable as the, month-to-month set fee revenue that we can actually value it at a pretty high rate. So if you think about, businesses like Ignition or Henry or whatever it may be, their revenue is tied to, the income that their customers are receiving, which is how they run their businesses, and is pretty predictable and pretty consistent and is quite reliable. So in that sense, where you've got great margins, reliable, predictable revenue that's unlikely to go away anytime soon, you can put a really nice value on it. The counter side to that is if it's not great margin and it's not predictable and it's a bit up and down, you're probably going to discount it pretty significantly. And I think that goes whether it's payments revenue or, we see a bunch of businesses with we charge for SMS capability or whatever it may be. Just really understanding the financial characteristics of that revenue line and how predictable it is probably feeds into the valuation point.
Yeah, no, that makes total sense. And Mark, you've mentioned the phrase mission critical software quite a few times, so I'm sure that may lead into the next answer that you have. But one of the questions that I'd had was around the types of SaaS businesses that you invest in, and thinking about what types of companies do you think don't do well during economic downturns? Are there any specific SaaS verticals now that you just really try to steer clear of? Maybe they're more cyclical industries, or it's a hard one, I know, but I'm really interested to find out.
Yeah, it's a good question. It's hard to answer because we've done just about every industry in the portfolio. If you look on the website, it's kind of comical. There's software for accountants and doctors and sports teams and everything in between. And it's all a bit crazy. Look, I think the truth, there are some industries that we look at, and I won't name them, but Some have great willingness to pay, some have really difficult willingness to pay, and some that's easy and rapid to acquire customers, and some it's a really painful sales cycle. None of them to say that you cannot build a great business in any of them or all of them. More to say on the way into an investment, it's just getting really deliberate about understanding, is this a business that's going to raise 40 rounds of venture capital and grow to be, some ginormous business, and it's huge market size, huge rapid growth, and, there's certain valuations you would apply for that sort of a business. There are others where it's limited market size, and actually a more capital efficient model is both probably appropriate given the market opportunity, and how much how much equity founders should be giving away. But also you can actually acquire customers much more efficiently. So you don't necessarily need to spend on huge marketing campaigns or anything like that. So I think it's less to say there are some we just avoid, more to say just have a real good understanding on the way in and appropriate value that sort of a business, and just be mindful of the capital journey that business is going to go on.
Yeah, no, that makes sense. And I think, I'd probably better ask something about AI during this interview. Seems like a sensible thing to do. And, AI in B2B SaaS is something that it feels like almost every business we're interacting with is either integrating or thinking about how to integrate AI into their products. How do you see the next year playing out for AI and SaaS, and how do you see that pan out over the next several years?
Yeah, it's a good question. It is dominating conversations. There was actually a great report put out this morning by Mary Meeker. If you know her, she's kind of the leading tech analyst in the world, probably. She did a whole thing on AI in university environment, which was just a great read. But it is the topic of the day. Look, I think for us, we're B2B software investors. Within that, we're happy to invest in new applications of technologies that are reasonably well known and being applied. So whether that's AI or that's some other technology, we're kind of keen to jump on board. And if I reflect on our current fund we're investing out of, it has 9 businesses in it. Of those 9, kind of 3 would be directly selling an AI solution, and all of them would have AI within their architecture. That really wasn't a deliberate thing. Like, we never went out to raise an AI fund or anything like that. It's more, I think, just a reflection that the best founders today are looking at artificial intelligence as just such a core, obvious building block to build the best software out there, that it just naturally seems to be the case. And that's kind of how our portfolio at least has been constructed on that front. As for where it goes from here, it's hard to say on different timelines, given it's all moving so quickly. I think the thing we're starting to see in certain industries, there was a bit of a sentiment that there aren't that many industries left that are going on the cloud adoption phase, which was the big movement over the last, call it 15, 20 years. What we're starting to see now, it's kind of the general trend of, on-premise horizontal software for everyone, to on-premise vertical software for individual industries, to cloud software for everyone, then cloud vertical software. And we kind of got to a point that, how many more verticals still have to go on this cloud adoption journey? I think what we're starting to see now is a new generation of software for some of those vertical industries that's actually got AI at its core that massively improves the value you can derive from that software, and is seeing kind of rapid adoption. The one in particular that comes to mind on that front is just the healthcare space, where there's been vertical software for doctors or for specialists, for GPs or specialists or allied health professionals for some time. What you're now seeing is, those old incumbent solutions that might be cloud-based and great are now being kind of, disrupted by folks that have a real strong AI lens that might be for something like, note-taking or something that is going to massively, can improve the efficiency of a doctor by 10% in a day, like really massive value out of that with AI to do, voice transcription stuff, to rapidly do all the note-taking and compliance tasks. Those sort of, new, approaches to cloud software leveraging AI seem to be disrupting some industries that maybe people thought were done, that are kind of really getting relitigated again by some new challenges. So that seems like a really interesting space that, we're looking at pretty closely.
Yeah, it's definitely really interesting just to see some of those efficiency gains that are created from AI. I think one of the things that comes to me to mind for myself is just around how do you think about AI solutions that don't have a big moat? Because it feels like at the moment there's two things happening. Is like you can really leverage AI at the core of a SaaS business that you're running and create internal efficiencies for your product, or you can actually sell a product that basically is just like a fully leveraging like an LLM or something like that, but it helps the end user do it a lot faster. But it's not necessarily that you don't necessarily have a great competitive advantage there on the basis that you're leveraging tools that are pretty available a lot of the time. How are you thinking about investing in those tools, and how much does the competitive advantage versus the first mover advantage play into that thinking?
Yeah, it's a good question. I think, step one is just getting a sense of whether there's a proprietary model in place that is actually defensible or not. Whether it's a proprietary model or a proprietary data set, I think is the question to ask. For some it is, and that's great. And you say, hey, that's defensible, let's get behind that. But I think you're right. For most of it, we look at and say, hey, you plugged in ChatGPT. Everyone can do that. How much of that is, really defensible? I think on that front, we just, lean back on what we've always looked at, which is to say, most of the founders building in B2B software that we back are generally industry insiders who have seen a problem, experienced it for themselves, decided to build a product to fix that issue they were having and say, hey, this is actually much more valuable. I'm going to build a software product around that. Because of that, they often have really nuanced insights into the UX or the product experience or what's really important and how to architect this solution. With that, they've got, they sell that into a customer base that goes through a whole change management process that's really, really difficult, really time consuming. And that, frankly, is, I think, where a lot of the stickiness and defensibility is. You've got people that love the product, they've been trained on it, all their records, they're in a system of record type stuff. And that's where a lot of the stickiness comes from, really understanding that piece. Even if AI is this new feature set that is maybe why it's a bit better, I think it's understanding that as a whole package of, why the customer's loving this, why is it really hard for them to shift off, and really have a good appreciation for that.
Yeah, that's really interesting. It's interesting to use the word feature set. Certainly, there's a lot of scope of what you can do with AI, and whether it ends up being a totally AI led product or just enhanced by AI. My view is that almost everything's about to be enhanced by AI at some level, including in B2B SaaS. And I guess just taking a step back from there, what are the other current trends you're seeing in B2B SaaS in Australia at the moment?
Other trends. Look, I think there's, if we think about trends, one thing that's coming, abundantly clear is it's a pretty hard time to be selling software. I think you touched on it at the start of the interview. It's rough out there. Like if you look at the US listed space, which I think is a pretty good proxy for probably what's going on in the market for most software businesses, it's a pretty tricky environment where sales and marketing spend is pulling back. But at the same time, as you would expect that to cause things to go more efficient, the opposite's happening. So payback periods have increased from 18 months to 32 months. Like that's a pretty dramatic thing over the last couple of years. Median net dollar retention rates have fallen from 119% to 110%. So you've got this weird situation where it's more expensive and more timely takes more time to acquire new customers. And once you get them, they're harder to keep on, harder to expand their usage, and are leaving more expensive to keep them around. So I think with that, this is more of, I suppose, an investor lens on this thing. It's not to say it's impossible to sell software, but the importance of having a truly novel technology that's going to enable you to achieve breakout growth that's really exciting to venture investors like us. You really need it. Like you actually have to have something that's 10x better or whatever it is to achieve those growth rates. And it's just becoming abundantly clear when you see that, hey, this is truly a really interesting business we should look at. Conversely, it's probably become a little bit easier for folks to say, maybe the venture capital pathway isn't right for me. And actually, hey, maybe this isn't something that's going to achieve year-on-year compounding exponential growth over time. And for those, it's probably the right moment to say, do I need to give away a whole bunch of my business to go and raise a bunch of money, burn a bunch of money and try and accelerate really quickly? Or is there a different path to building a fantastic software business that can get of scale, but a little bit slower, a little bit more considered? So that's less an exciting trend per se, but I suppose just looking at the software landscape, I suppose it's now seems to be an environment between, pullback in funding, more difficult to sell software, that, it is more clear as to which businesses venture capital is a really appropriate pathway, and for which businesses the founders would be way better off not touching venture capital, not giving away part of their business, which is probably a healthy thing.
Yeah, sure. And I guess with that current outlook in mind, what's your view for the future? Do you think it's going to become easier to close sales, and some of those things that you talked about?
Yeah, certainly. I think, we're optimists over here. And look, for most of our businesses, to be honest, they are still selling like hotcakes because they've got amazing products and amazing solutions. But yeah, overall, I think there'll be a recovery as, interest rate uncertainty and all the rest of it probably equalizes. So certainly we're optimists on that front. And even, funding markets, be it in, over on your side or in Australia, they're still very much on exciting long-term trajectories of, growing and growing and growing. And the venture landscape's improving, and all the rest of it. It was more just a temporary crazy mania for a couple of years that's now reverting back to that long-term trend. And certainly we're still incredibly excited by the outlook for B2B software and technology generally, particularly out of this part of the world that's still playing catch up on, venture dollars per capita and that sort of thing, where we're still well behind. So we're still incredibly bullish on the opportunity. I think it's a short-term, economic blip, I hope, that's kind of causing some of those phenomenon. But still very bullish about the quality of founders and the strength of the businesses coming out of this part of the world.
Yeah, likewise, definitely echo those thoughts. And last question, Mark, what would your advice be to B2B SaaS founders or entrepreneurs that are looking to build and maintain resilience in their businesses?
Good question. I think it's a lot of the stuff we've talked about, right? Like just having a really clear, honest perspective of where you do a product market fit and where you don't. As much as you can probably acquire some customers, they might not be profitable. They might churn after a month or two, and you probably were better off not finding them. So getting really clear on that, getting really deliberate on kind of cash burn and capital management, and having a clear plan and a clear risk stance with your board is really important. And then, just getting really close to your customers, understanding, when is the right time to think about a price rise, when is not the right time to think about a price rise, what are they going through in their industries at the moment. And I think that just will hold you in good stead, whether it's on product development, how you think about resourcing, go to market, and how you think about some of those strategic points as well. So, those are probably the three, but
Yeah, no, cool. That's a great answer. And Mark, thanks a lot for your time today. It's been great hearing about some of your insights, and certainly if you're a B2B SaaS company looking to raise capital, I'm sure you can reach out to Mark directly or get in touch with someone at EVP.
Yeah, please do. And thank you, Ryan. Really appreciate the time today.